Have you ever wondered if you could get paid just for owning something? No work, no effort, just cash flowing into your account? It might sound too good to be true, but in the world of investing, it's absolutely possible. Today, we're talking about dividends, how they work, why they matter, and whether they're really as magical as they seem. Ready to discover the hidden power of dividends? Let's dive in. Let's start with the basics. Dividends are essentially profit-sharing payments made by companies to their shareholders. Think of them as a company's way of saying, "Thank you for believing in us." When a business generates more money than it needs to grow, it distributes a portion of that profit back to its investors. It's like getting a slice of the company's success delivered straight to your bank account. But here's where dividends stand out. Unlike the interest you earn on a savings account or bond, dividends grow over time if the company thrives. And for many investors, this steady income stream is a key part of building long-term wealth. How do dividends work? Imagine this. You buy 50 shares of a company and each share pays $1 in annual dividends. That means you're earning $50 a year just for owning those shares. Sounds simple, right? But there's more. Many companies pay dividends quarterly, so you'd receive $12.50 every 3 months. Multiply this by several stocks and you've got yourself a tidy income stream. Cash versus stock. Dividends typically come in two flavors, cash and stock. Most companies distribute cash, depositing the money into your account, but others may give additional shares of their stock instead of cash, allowing you to grow your investment without lifting a finger. Who decides the dividends? Here's something you might not know. Dividends aren't guaranteed. The company's board of directors decides how much to pay and when to pay it. They weigh factors like profitability, growth opportunities, and market conditions. If the company's finances take a hit, they might reduce or even stop paying dividends altogether. Why do companies pay dividends? At this point, you might be wondering, why would a company give away its hard-earned profits? The answer lies in two reasons: loyalty and confidence. Companies use dividends to reward shareholders for their trust and investment. It's a way of sharing success while keeping you invested in their journey. Dividends are also a statement. When a company consistently pays dividends, it signals financial health and stability. It tells investors, "We're doing well and we're confident about the future." That's why mature, well-established companies, think Coca-Cola or Johnson & Johnson, are more likely to pay dividends than fast-growing startups. Let's talk about the good stuff first. Dividends offer several advantages, including passive income. Regular payouts can supplement your income or fund expenses. Stability. Dividend-paying stocks often perform better in volatile markets because investors value the steady income. Reinvestment opportunities. Through programs like DRIPs, dividend reinvestment plans, you can use dividends to buy more shares, fueling compound growth. But like anything in life, dividends come with trade-offs. Slower growth. Companies that pay high dividends might grow slower because they're not reinvesting profits. Tax implications. In many countries, dividends are taxed, potentially reducing your take-home income. Cuts or suspensions. If a company hits financial trouble, they may reduce or stop dividends altogether. Here's something interesting. Dividends can influence stock prices in surprising ways. When a company announces a dividend, its stock often rises as investors rush to buy shares before the ex-dividend date, the last day to qualify for the payout. After the ex-dividend date, the stock price typically drops by the dividend amount. It's a predictable pattern, but one that confuses many new investors. Are dividends really free money? Let's tackle a common misconception. Are dividends really free money? Not exactly. Dividends come from the company's profits, which means the money isn't magically created. It's just being redistributed. In a way, receiving a dividend is like withdrawing a portion of your investment's value. But here's why that matters less for long-term investors. As long as the company remains profitable and grows over time, your initial investment and your dividends can continue to grow, creating wealth in the long run. Now that you understand dividends, let's talk strategy. How can you maximize their potential in your portfolio? Focus on dividend growth stocks. These are companies with a strong track record of increasing their dividends annually. They're less about high yields today and more about consistent growth over time. Dividend aristocrats like Procter & Gamble or Microsoft are prime examples. 2. Balance high yield and stability. While high yield stocks offer immediate income, they're often riskier. A balanced portfolio includes both high yield investments and stable dividend payers for long-term security. 3. Use DRIPs to reinvest. Dividend reinvestment plans let you automatically reinvest your payouts into more shares, amplifying the power of compounding. This set it and forget it approach is ideal for growing your portfolio over time. Here's the million-dollar question: should you invest in dividends? The answer depends on your goals. Dividends are a fantastic way to generate passive income and build wealth over time, especially if you're planning for retirement. They're also great for investors seeking stability in uncertain markets. When to avoid dividends? But not all situations are ideal. If you're focused on aggressive growth, dividend stocks might not be your best option, as they typically have slower capital appreciation. Similarly, if a company is borrowing money to fund its dividends, it's a red flag. Avoid those stocks like the plague. Dividends are more than just financial payouts. They're a pathway to financial independence. Whether you're looking for passive income, portfolio stability, or long-term growth, dividend investing offers something for everyone. The key is to understand the risks, focus on quality companies, and stay consistent with your strategy. Ready to start building your dividend empire? Subscribe to the channel for more insights on investing and personal finance. And don't forget to hit the like button if you found this helpful. Let's grow your financial future, one dividend at a time.